Hey, this is Hudson Berry, and in this video, I'm going to be talking about the statement of cash flows in general and why it is useful and what it can tell you and how it relates to the balance sheet and the profit and loss statement. And we're going to start out looking at a specific company's statement of cash flows that is maybe got some issues that we're going to pick out. And then we're going to move from that into looking at a statement of cash flows from a company that seems to be doing a little bit better, perhaps in a long term, um, from the standpoint of long term financial strength. So, with that, I'm going to share the screen here, and there's going to be a lot of information on the screen. Um, but don't try to take all of it in. I'll point out what's important. Just hang on here. Okay. So that's not quite what I wanted to do. Let me redo that. Background. That's what I needed. I'll put myself on there so you will see my face because, well, I don't know if you want to see my face or not, but anyway, there it's going to be. Let's see here. Okay. I think that's right. So, what we're looking at here is on the left side here. We're looking at the statement of cash flows for the Advance Auto Parts, and it's for the 16 weeks, basically a quarter, ending April 22nd, 2023. And this is old, so there's been a lot more activity since then. And anything I say in this video should not be taken as any sort of advice or anything regarding the investment worthiness of this company. This is based on old information. So what we're looking at over here is a statement of cash flows, and don't try to take all of it in. Just look at this top line right here to start with. Cash flow from operating activities. And what you start with is the net income adjusted for some of the non-cash expenses, such as depreciation and amortization. So, for example, the company calculates net income of 42,651,000 for this period. Well, a lot of their expense was depreciation, and that's not a cash outflow. It's just an accounting entry. So you add that back in to determine your cash flow from operating activities. And there's other things that are added, such as accounts payable. It's not an expense, but it is a cash outflow. That's an operating activity down here. So at the end of the day, when you get to the bottom, net cash used or brought in this case, used in operating activities is 378,865,000. So while we have a net income for that period of 42,651,000, the cash generated from operating activities, it's actually cash used, and to use a non-accounting term, in the hole, 378,000. So that's one thing that's interesting about a cash flow statement is that you can see not just what the company's net income was, but how its cash was used in operating activities. Now, there's three sections here. There's cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Cash flow from investing activities has to do with, in some cases, it could be just investing the company's assets that it doesn't need for operations, or it could be, as what's listed here, purchase of property and equipment. So if you look at what they've done, they've sold some property and equipment, 325,000 worth, and they've purchased almost $90 million of property and equipment. So the net use of cash in investing activities is also negative. They have used more cash than they've brought in. So in the first category, operating activities, they have used about 340 million, and in investing, they've used about 90 million. Now, cash flow from financing activities. This is such as uh, debt, payment on credit facilities, borrowings under credit facilities, payment on notes, borrowings on notes. This is debt, and it also shows dividends paid to investors and purchases of common stock. So if you look at where their money's coming from, so first of all, down at the very bottom, you see cash and cash equivalents end of period is 226 million. At the beginning of period is 269 million. and they had a net decrease of 42 million of their cash. The first two categories are what account for that. They lost used cash in operations, they used cash in investing, and they gained cash in financing. So, what does that tell you about this company? It means their operations did not bring in cash, and it means their investments did not bring in cash. And it means that the only cash they brought in came from financing, which is probably, it could be fine for one period of time, but it's not something you want to see over time. Over time, you really want to see positive cash flow from operations, positive cash flow from investing, and it really, for the health of a company long term, you want to see cash from financing basically reverting to zero, whether it be negative more often or positive more often. You kind of want it to be reverting to zero, but you want the top two to be, certainly the top operating activities to be positive, and then cash flow from investing to be positive, if anything. So this company has been borrowing a lot of money, and if you, the other thing I want to look at here is in this issue of the Standfast report, which I wrote on August 20th, 2023, there's a section here on Advance Auto Parts. And if you go down to the second page, what I'm discussing here is the ratio of liabilities to assets. And they have a relatively high ratio of liabilities to assets, 7.78. So 78% of their assets are financed by liabilities. Kind of corresponds to what we're talking about on the cash flow statement. So 48% of those liabilities are long-term. And the company's current ratios and quick ratios calculated year-end from 2012 to 2022 seem to indicate that they have maintained the ability to meet their current obligations. So they're not having trouble paying their debts, but they do have a lot of long-term liabilities. And what we see down here is that, or what I'm suggesting down here is that this ability apparently includes the option to move portions of AP, which is part of short-term liabilities, to long-term debt, such as the notes that they issued, which I'm going to discuss right here, which the company arguably did with 440 million of the 599 million of note issuances on March 9, 2023. Okay, and then I have a footnote on there just to explain that. On March 9, 2023, we issued notes, two kinds of notes, just skipping over some of this. Proceeds from the notes were utilized to make payments on our revolving credit facility, which is more of a shorter term debt instrument, and to supplement operational and capital expenditures. That just means they need more cash for operations and investing, operating activities and investing activities, which is representative of on the cash flow statement, because they have positive income from, not income, positive cash flow from financing, negative cash flow from operations and investing. And that information is, well, skipping down here, borrowings on senior unsecured notes was 599.77 million. Okay. So this is represented right here on the cash flow statement under financing. They borrowed money in this period, 599.57 million. And the difference, here's where we're explaining how that is used. And this is where it's going to relate to the balance sheet, which we can go look at in a second. But the difference between borrowings and payments on credit facilities was 69 million, which is these two numbers right here, borrowings and payments on credit facilities. Purchases of property and equipment was 89.99 million, which is under investing activities. And a reduction of AP was 441 million, which is right here under operating activities. These three items correspond to the stated utilization of the notes issued, which add up to 599 million. So basically, they borrowed this long-term debt in order to reduce their account, in order to pay off a short-term debt, which is accounts payable, and in order to buy property and equipment. So they didn't have it from any of their existing cash. They didn't get the cash from operations, and they didn't get it from investing. They borrowed it. And they basically took the cost of those of that accounts payable amount and the property and equipment and borrowed money, long-term money to do that. So if you want to look at this on the balance sheet, we can see how it's going to show us. Well, I'll just show you right now. So switch over to the balance sheet for that period of time. And if you look at and I'm not going to explain the whole balance sheet right now. I'm assuming you may already know what it is, but what we want to look at is the liabilities section because that's where this debt activity happens. So if you look at accounts payable right here, they issued those notes in this period. And here's the numbers in right-hand column are for the December 31, 2022 period ending. And in the left-hand column is the period during which is the end of the period during which these notes were issued and used and the proceeds used. So if you go on down here to accounts payable, the difference in these two numbers should be about 440 million. 4123, 462 minus 36, 82, 749. 440 million. Okay. So their accounts payable did go down by that much. And if you want to look at long-term debt, what we're saying is that went up by 599 million. That's the suggestion here. So that's current liabilities. Current liabilities should have gone down by that much, the 440 million. Long-term debt should have gone up by about 599 million. That's this line right here, right here. So 1784, 596 minus 1188, 283, 596,313,000. So basically 599 million. Their long-term debt went up in the period of time covered in that cash flow statement. So that's an example of a company that's basically, and again, this is not any kind of financial advice, and there's been 2-3 years of activity since this time. I guess 2 years, a little more than 2 years, 2.5. So things have changed since then. This is old information. I'm not trying to say anything current about this company, but in a way, it looks like this company is sort of kicking the can down the road by converting that shorter term, perhaps higher interest debt into longer term, lower interest debt. And maybe it's a move they just have to do. Maybe they have no other choice, but they're essentially paying off these credit facilities, as you can see on the cash flow statement under financing. They're paying off the credit facilities. Well, it's a net payoff. Their payoffs are more than the borrowings. And then they're borrowing. They have a net borrowing under the long-term senior note, senior notes, which are long-term. So they're trying to move their debt into long-term debt. And that's going back to the letter here, the issue of the Standfast report. The suggestion here is that their ability to pay their current liabilities is in a large degree enabled by borrowing money long term. So that's what that shows. So just to go real quick and look at a different company that has what we might call a little bit more healthy financials, or at least stronger, just on the surface. And this is no deep level analysis. It's just a surface level analysis. We'll go look at the cash flow statement for Sturm Ruger and Company this is just a recent one. June 28, 2025 is the statement of cash flows we're looking at. And there is some interesting things to look at here. So the net income was negative. We're going to talk about why in a second. It's typically it's slightly positive. Let's just say that to oversimplify things. Their investing activities provided some cash. If you look down here at investing activities, their cash from operations was positive, and we'll look at why in a second. Financing activities was negative. And if you see what they're doing with cash and financing, what they're doing is they're repurchasing stock and paying dividends. Those are the key activities in their financing section. So what that means is that they're giving money back to shareholders, essentially. So they're not using it to buy equipment. They're not using it to pay off debts. Well, they are paying off debts because they don't have very much and they're paying them off routinely, but they're using cash that was provided by operating activities, as you can see in the top is positive, and investing activities, and they're giving it back to shareholders. This is an example of a profitable company that has positive cash flow that's sending the money back to shareholders. This is one of the things that distinguishes this company from the other one we looked at earlier in terms of cash flow management and how it is potentially on a first glance, top level, first impression, healthier. And again, this is not a deep level analysis, just surface level. All right, so real quick, let's look at the operating activities of Sturm Ruger and Company for the period ending June 28, 2025. And if you look at net income, it is negative. But some of these items below it are adjustments to get you to the cash provided by operating activities. Now remember, the cash flow statement represents where the cash came from and where it went to. It's not a statement of net income. In other words, it's not what the income statement is, which is income minus expenses equals net income. Net income is at the top, and that is adjusted for things like, for example, most significantly in this period is the inventory and other asset write-off of $17 million. Okay. That's something that the new CEO did, I believe, in the first, well, I guess it would, I'm not sure what their fiscal year is, but anyway, before June 28th, 2025, he started either late last year or early this year. And one of the things that the company did under his leadership was write off a bunch of inventory. So it's a journal entry. It's an accounting entry. It's not cash out, but they have to record it because it's appropriate to record it as an expense because they are writing off the value of that inventory because they either can't use it or they didn't have as much as they thought or whatever it was. I don't know exactly what it was. But basically, this is a non-routine entry. And it is deducted, or excuse me, added back to the net income to help you see what the actual cash flow from operations was, if that makes sense. So there's all these other items as well, such as depreciation. So depreciation is a non-cash expense. You have to record it because your equipment loses value over time as it gets used. So there's a depreciation expense that's added back to this negative net income amount. And you've got this 17 million inventory write-off, which is added back. And so this cash provided from operations, the cash the company brought in from operations was 25 million. They brought in 10 million from investing activities, and they used 23 million in financing activities, basically by repurchasing stock from their shareholders and paying dividends to their shareholders. So the money's coming in from their business operations and going to their shareholders. To me, that's pretty cool. Just to look at the investing activities real quick, I thought it was interesting. Purchases, they do have investments that they're buying and selling. It looks like from this section of the cash flow statement that it's pretty much a rolling operation. They're just doing it all the time. And so I thought, well, I wonder what those short-term investments are, because they purchased short-term investments of 63 million and they sold short-term investments of 81 million. So what are those short-term investments and why are they using the cash that way? So I looked in there, it doesn't say in this 10Q for the period ending June 28, 2025, what those short-term investments are. So I went to the 10K, the most recent 10K. So as of December 31, 2024, if you look down here on the left, and I highlighted it here, hopefully you can see that on your screen, the company's short-term investments consist of U.S. Treasury instruments maturing within 1 year and investments in a bank-managed money market fund that invests exclusively in United States Treasury obligations. So in other words, it's probably buying Treasury bills or other Treasury instruments that mature within 1 year. In other words, the investments that this company has are basically the safest investments on the planet from a um, risk market risk standpoint. U.S. Treasury securities with short-term maturities they offer high liquidity, not necessarily very high interest rates, but recently they have been relatively competitive on rate, and anyone will buy them anytime. The market is very liquid, so it's almost like having cash in the bank, but there is a higher interest rate than most bank accounts. And then they have also money in this money market fund, which means they're not companies not directly buying those instruments with all of this investments money that they have that we see activity in the investments activity section of the cash flow statement. They also have some money in a money market fund that also invests in U.S. Treasury obligations. So either way, all those instruments, all those investments on the statement of cash flows are basically the safest cash or cash equivalent cash and cash equivalents category of investments that are very, very, very safe because they're basically investing in the U.S. Treasury. So that's about all I have to say about cash flow statements at this time. I hope that was a good summary of what it can tell you about how a company is really doing. So just one quick note real quick. One of the reasons that this might be important to look at a cash flow statement for, say, Ruger for this period of time, or at least for this year so far in 2025, is that when they did that inventory write-off of 17 million, their PE ratio shot up to the high double digits, as I recall, something like 70 or 80 something. So it makes it look like, oh my gosh, this company's losing money. They're going down. They found a problem. But if you go, and they said as much in their press releases. I mean, they were definitely sure to tell people why they had that negative net income. And this is the reason, in large part. They wrote off a bunch of inventory. So if for some reason you couldn't see the press release, or if for some reason there wasn't a bunch of people covering the company, which there are some, so you don't really have to worry about it. But if for some reason you didn't have those other people and the company itself talking about it, you could look at the statement of cash flows. Why did they have a negative net income? And did it affect their cash from operations? Anyway, good questions to ask. Hope that was helpful. And that's all I got. Till next time.